Okay, good evening, guys. Yeah, a couple of people in the room now, so we can do that. I guess there's no point doing it just for one person. But we're going to talk about the Elliott Wave tonight, and it's always good that we do the live webinars because people can ask questions, and there's certain things you don't get, you can always get back to me. The whole point about our webinars in InterTrader is that we try to give something back. It's not just about a pre-recording or just letting people listen to the same old information. It's trying to get you to understand the things we're trying to put across. Why we put the effort into the presentations we do, and why we give you the kind of trade ideas and the trade techniques and tools that we use to make money as professional traders. So before I start, as always, remember the risk warning. Remember that spread betting and CFD trading both carry a high level of capital with the possibility of losing more than the initial investment. These products may be suitable for all investors and only intended for people the age of 18. Please ensure you're fully aware of the risks involved and necessary seeking independent advice. Education only. The content of the webinar is personal opinion of the moderator, not insured.com. The content is not constitute financial investment or tax advice. We recommend that you discuss your specific requirement with an independent financial advisor prior to entering any bet. Insured.com does not accept any liability of content during the session. So, what is the Elliott Wave? Well, the Elliott Wave, first and foremost, is a theory. So, it's a theory about price movement. It was developed by Ralph Nelson Elliott, and it's a very popular tool that traders use alongside things like Fibonacci to understand how price movement, price action works over a period of time. So it's really based upon the notion that markets move in a cyclical manner, and we all know that they do. Markets go up, markets go down. So what we're trying to figure out is when they're going to go up, when they're going to go down. Now, the basic interpretation is that trends are seen in most markets, but a trend is quite easy in some respects to find. If a market goes up or goes down, we can see, a market's exhibiting that price action, but it's how it's going to do it and when it's going to do it. That's what really kind of catches out a lot of traders. A lot of traders can be right in the direction of a market, be it up or down, but still lose money on a trade. So what the Elliott Wave tries to do is to break down movement into patterns that we can look for, identify, and trade with. So really, it's into 5 main waves. So that's how the Elliott Wave theory interprets candlesticks, line charts, bar charts. It doesn't matter what the kind of chart is. What it's trying to do is group movement together to understand that it moves in certain characteristics. So the first wave, is the trend beginning to form. Then the second one is a corrective phase. Third is generally the most powerful move of the cycle, where we see the biggest move and potentially the biggest profits to be made. Then we see number 4, a corrective phase, very, very similar to the corrective phase of part 2 of the wave. And then final is the kind of bubble effect, where we've hit critical mass before the trend actually bursts, and we have to naturally then retrace that movement. The real difficult part with the Elliott Wave is that it is a theory. So although there were some basic rules to follow, and when I say basic, there's some seemed complicated at the time that the wave theory was brought, but really in modern day tradings it isn't that difficult to interpret. What you're looking for is a structured movement where we see directional moves with limited retracement. That's all the Elliott Wave is. Now, I've said in the past that I'm not against the Elliott Wave, but I don't really kind of do things in moderation. I'm looking for absolute things that I can control and understand within the market. What I don't like about the Elliott Wave is you don't know an Elliott Wave until it is an Elliott Wave. And also, because it's a theory, it's open to interpretation. So interpretation is difficult because sometimes it works in exactly the way you want, sometimes it doesn't. So realistically for me, the Elliott Wave is a great tool when it works, but also, I guess, going back in hindsight, anything's great when it works in hindsight. What we're looking for in modern day trading is something that works when we want it to work and we understand how and why it works. So really, when we look at the Elliott Wave theory, we're looking at the first wave, a directional move. So what we're looking for is the market to exhibit a particular direction, a particular trend. The market goes down, the market goes up. I guess when you see the Elliott Wave, generally with most types of traders, they're always looking for an up move. Generally, down moves are frowned upon by traders. So the first wave, when we talk about the Elliott Wave with general traders, is that the market is moving from the low to the high. Okay? Sorry. My coat. My barber. Yeah, idiot. Sorry, so yeah, the markets move up, the market moves down. But generally what we're looking for is the Elliott wave to be moving that upward direction. So what we're looking for is this first wave. The first wave tells us everything we need to know, and that is that we're looking for an upward directional move, and the market has moved from a low point to a high point. Now, anyone can look at a any directional move and say, yes, of course, that is what the market should be doing. The market's gone from the low to the high, and that could be then something we want to do. We want to buy low, want to then sell high. But what we're looking for really is the start of a move. We're not looking necessarily to buy low and sell high here. What we're looking for is the market to exhibit a strong trend. Now, the strong trend works in individual candles, clusters of candles. It works in Fibonacci. It works in Elliott Wave. And what we're looking for really is something to kick us off. So this point from the low to the high gives an idea something could be happening. But really, we're not interested into the Elliott Wave, I guess, until maybe this point here. Because, again, with it being a theory, markets move low to high. What we're actually looking for is this wave theory to present itself before we can make the most defined trading calls. So we get to the second point. This again, what we know in the past is this. We don't know anything past this line to the right, but we know the market's gone up. The market then in the second phase is retraced. But key and absolute pivotal, to the Elliott Wave theory is it's not retraced to more than 50% of the move. Okay, again, you can tie that in with Fibonacci, another key principle we teach. But the market's gone up, it's gone down, it's retraced. What it's not done is retraced too far into the previous wave, and that means it's still valid. So as it starts to build up, you see that we've got the first wave, correctional phase, hasn't moved back to the 50%. So again, we don't know it's an Elliott wave yet, but we've got a fair chance that it could turn into one. Now, the third part of the wave is meant to be the most strongest part of the moving direction, and both the direction and speed of movement. So what you're looking for then is a very steep curve for the market to move up to show us that it could be, again, potentially an Elliott wave, because until 0.5 we don't know where it is, but we've identified wave 1, correction, wave 2, then the market's moved up quite aggressively, and that's wave 3. So you don't necessarily have to make your money from here to here. You don't have to make your money selling, and realistically, once we've passed the high of 0.1, then we're really kind of guessing that this potentially could be an Elliott wave because we're halfway through it. So this is where you're looking to make your money. Again, this whole extended part. So the Elliott wave is very clear that it should be an additional, a move with a retracement, but the additional third part or third wave should be bigger than 0.1. So again, that's the whole makeup of the Elliott wave. Market moves up, retraces, then moves in a greater speed, greater direction than the first wave that it was conceived from, should we say. Fourth wave, again, very much like wave 2. It's a correction. So what it can't do is come back into 50% of the most powerful part of the wave. What it certainly can't do is dig back into the range of the wave that conceded it. So again, 1, 2, 3, 4. You can see how the wave's building up. So what we're looking for is almost the crest of the wave to happen at 5. So 0.5 is we have to make a new high from 0.3. We cannot get back into the range of the third part from 0.2 to 0.3. So again, the retracement has to be somewhat quick in nature, because it has to, again, let people take profit from wave 1, on wave 3, but the market then can't delve back into that major wave, and then the market has to make a new high, and then that is essentially an Elliott wave. So the Elliott wave, we don't know it is an Elliott wave until it makes a new high here. That is the only point we know it's an Elliott wave. We've seen 0.1, we don't retrace back into the range. 0.2 to 0.3, the third wave is the biggest. A small correction, the market makes a new high. At that point here, that is then an Elliott wave. But it doesn't stop there. That's the whole point about Elliott wave, which makes it kind of so frustrating in some respects, is that is an Elliott wave, but it's not actually an Elliott wave in completion until it's then corrected. So it's an Elliott wave in formation, but it's not an Elliott wave until it's completed. So what we can see, we'll come to that in a minute, what we can see in the candlestick charts is the same scenario. Say, if you don't know anything past this, this line here, we know the market's moved up, 5 green candles. Market comes back down. Market then exhibits the strongest move up, comes back down to the trend line, goes on to make a new high. That means it's then an Elliott wave. It continues that upward trend, but Elliott wave, Elliott wave, Elliott wave. by the 3 highs that are made and the small correctional 2 phases that we see. And again, it doesn't necessarily look as clear cut on the candlestick charts, does it? And that's why you have to, again, draw in your trend line to give you a baseline. But it's the highs and the way it moves, and it's the retracements that show you it's an Elliott wave. And all of a sudden, reading between the candles, you see that's an Elliott wave. And again, that's something you can translate into your everyday charts. But it doesn't look as clear cut on the candlesticks charts, and you can miss it. So now we've identified the 5 waves to make an Elliott wave. You have to understand that to be a complete Elliott wave, you have to have 3 stages known as the selling inertia. So, that's what makes the Elliott wave so frustrating is you've seen Elliott wave, you've seen how difficult it is to interpret. Once you've found it, you don't necessarily know it's a true, absolute Elliott wave until it's corrected in 3 points. So, again, it's 8 points before you know it's a true Elliott wave. Now, you tell me, is that something that is forward-looking or very, very perfect in hindsight? So what we're looking for then is these correctional phases. So the correctional phases work in the same way as the up movement. So we've seen the highs, we've seen the retracements, okay, and that's what makes the actual Elliott wave. The correction, it works in the same way. We generally see the market move down. It generally finds support on the previous point of where we found support on the correctional phase of the wave, point 3 to 4. And then the market can't make a new high. So again, it cannot absolutely make a new high above the Elliott wave, and then it breaks through and gets back into the previous range. So what essentially looking for is the market, after it's made the Elliott wave, the new high, it cannot make a new high. It ranges, and then it has to make a new low, or else that's not corrected. Okay, so the point 1, point 2 to point 3. Point 1, it has to come down, but not too aggressively. It has to bounce, but not make a new high. And when it retraces, it has to then make a new low significantly into the range of the previous trading. So the inertia wave, the inertia selling wave, the key point is it cannot make a new high. It has to wait before it makes a new low. And when it does make that new low, then essentially that is a complete Elliott wave. So you look at the candlesticks, exactly the same. Looking for essentially the trend line to be broken. So we get the highs, we get the lows, but what we see is the market break from what was support. Support becomes resistance. We cannot make a new high from the 5th point, the Elliott wave, and then all the points previously that were support on the buying wave become resistance and the market sells down. So you expect the market then to get down to this next point and to where the wave initially started. So again, it can only really start to aggressively sell off after that second point where it fails to make the new high here. And that again means that it's a full Elliott wave once it makes and breaks a new low for the third part. And it can go as low as it wants. It can stop to a tick. And that's what, again, the Elliott wave doesn't give you any defined points of entry, exit, and it is a theory. But if you put all the pieces together, you can get involved in the movement. And that really, for me, is the movement in wave 3, okay, and the movement in point 3 of the selling correction inertia. So I guess the 3 main rules when you're trading Elliott wave you need to look at. Okay, so the wave 1, when you're seeing it form, it should never retrace to 100% of the move. I guess 61.8 is the maximum, but realistically for me, use Fibonacci. Anything that goes half into the range is going to be too much. So 50% is the maximum. Wave 3 can never be the smallest wave. It has to be the biggest wave by far. If it's not the biggest wave by far, it's not going to be a proper Elliott wave. And wave 4, the correctional phase should never break back into wave 1, but essentially every retracement part should not go back into more than 50% of the move that created it. That's what makes an Elliott wave. Don't force the Elliott wave. I mean, this is the basic principles. If it doesn't want to be an Elliott wave, it won't be. The whole point of technical analysis is self-fulfilling. So if it looks like an Elliott wave, people think it's an Elliott wave, it may be an Elliott wave. But don't be the only person trading it. Trading is self-fulfilling. So if it doesn't look like an Elliott wave to the majority of people, then you can't force it and you will lose money. Okay? So understand the 5 waves, the 3 corrections have to be blatantly obvious. Again, you can trade it however you want. If you want to buy into the dips, absolutely fine. Again, the safest way of trading, as always, is going with the trend. So if the market's going upwards, as we see through these points here, then buy the lows. As the wave goes down, buy it. As the wave goes down, buy it. Don't try and be too clever. Don't try and buy it and sell into the correctional phases. either be trading it with the trend or against the trend. So don't buy it, sell it, buy it, sell it. Either sell it at the highs for a small profit or buy at the lows for a larger profit. For me, always going with the trend. That's the way to trade. So an uptrend, you buy the Elliott waves and the dips. Again, rejections, however you want to look at them. You can look at them as candlesticks. You can look at them as, again, trend lines, whatever suits you. We've seen 1, 2, 3, 4, 5 candlesticks make an uptrend, 3 correct, and then 1, 2, 3, 4, 5. Yeah, a little bit of consolidation here, and then more green candles. So you'll always see green and red candles showing you the up and down direction. So go with the direction, candlestick bodies, individual candlesticks, all the things that we've always used in previous trading. And again, I mean, you can look at gaps like we see here, individual candlesticks like this, dojis, doesn't really make any difference in the overall picture. You know, individual candles will still behave in the same way. So, you know, you've seen 1, 2, 3, the biggest wave happen here. Then maybe that with the individual doji is the perfect place to sell back to the trend. You might only make 30 ticks out of that. But if you're selling back to the trend line, then great. Doesn't matter how you make the money, as long as you make the money in the way you know how you can replicate. So you might sell every high in the Elliott wave, you know, on the correctional phases. Then you might buy every low on the upswing. Again, whatever makes you the money, it doesn't make any difference. I guess the higher up the range you get, the more confirmation you get. So as you get to point 4, which turns into wave 5, you've already seen 1 to 2 correction, biggest wave, point 4 correction. So the chances are that you're going to make a new high. So all you're doing is buying on the trend line. And that really is the safest part because you've got confirmation, 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 confirmation. Then all of a sudden, all you're trying to do is buy it into a new high. And that's self-fulfilling. The more people look at that, the more people buy into that new high. I guess deciding where each phase begins and ends up to you, and that's what makes it really difficult as a trader because it's the interpretation thing that I find the most difficult to get on board with because you might look at an Elliott wave in a different way than I do. You might look at the candlesticks a different way than I do. I can't tell how you interpret the charts or candlesticks. What I can understand is that what happens in the past will happen on the future. Graham's asking a question: what time frames do we work on? Well, I mean, it really does depend. You know, the shorter term trade you're looking for. Will generally start about on the 15-minute chart. Probably the Elliott waves work better on higher time frames. I'd say hourly and daily are generally better for the Elliott waves because you need time for it to set in, people to identify, and for it to happen. So, I mean, again, also think about Elliott waves. Elliott waves work within Elliott waves. So you can see the market's moved an Elliott wave here, the highs, the lows, but in the mean part, the Elliott wave has actually made an Elliott wave in the third part. A little bit too techie for me, that, to be honest. I don't really think that that's a good way of using the Elliott wave. It's more for a longer term trend, so don't try and break the smaller term trends down. Use it for the longer term trend. I guess it's very visual. That's the advantage of the Elliott wave. You know, it's visual. Once you see it can work. It can work because it's visual. It can work because you can identify highs and lows. You can see patterns. Now, it doesn't give you exact entry points, but it gives you an idea of momentum coming to the market. And that, for a lot of traders, is where the difficult part is. Being right and knowing you're right. An Elliott wave can break that down and then make you get involved in the trade and stay in the trade, see it through. But I guess the main down point of the Elliott wave is it is a theory, and you don't know it is what it is until it is. And again, that comes onto the disadvantages that it's because it is somebody else's theory, and everyone else can then interpret it however they want. It's very difficult to know when you should be involved, when you shouldn't be involved. I think for me, it's the safest part. So be involved in the meat. If you identify an upward trending market, don't get involved until phase 3, where you've got the most chance of success, or point 5, the most chance of success. When it's selling, don't get involved into wave 2, so it's breaking back into the range, so it's doing things that are confirmed. The biggest thing about the Elliott wave is confirmation is hard to come by. So if you can confirm it within the waves as it's making itself up, you can't ever confirm it until it's done, as I said, but you can then get involved in the highest percentage point of probability of success. All right, guys, any thoughts, any questions? I mean, I think the Elliott Wave is one to kind of look at and If it works, it works. If it doesn't, then there's obviously lots of things like RSI, Bollinger Bands, Fibonacci, all the things we've mentioned before. That can help you identify levels and other types of trends. Nothing else, guys? Anything else you'd like to ask? I mean, again, Elliott Wave is not my favourite, to be honest. You know, I do teach it, but it's not something I use in my everyday trading. Like I said, try the Elliott Wave out. Try and identify it on the hourly charts. Maybe try and identify it on the daily charts. These will give you the best results and the best kind of ideas of success. Anything else you want to ask me, get me on Twitter at Steve Ruffley. Email sruffley@tradermaker.com. And obviously, this is recorded, so you can go back and listen, to what I'm saying, look at the charts, and try and identify it. What systems do I use? Well, I use my own systems. I use my own systems, Google iView charts. I use generally Fibonacci combined with Bollinger Bands, hourly and 15-minute time frames. That's generally what I do. But again, there's a million and one different systems. What I'm trying to teach you is a framework of things you can use, and then put them together and find out what works for you. I can't teach you my trading system because you haven't got the 15 years of experience and you haven't got the money I've got. So again, it's down to you what you use for your system. All right, guys. Well, hope you enjoyed it. It's been a pleasure. And anything else, get me on the email. All right, guys. Have a great evening. Thank you.